Could history be poised to repeat itself, leading us to another devastating real estate crash like the one witnessed in 1986? If the past is any indication, meddling with real estate, especially by Congress, has always resulted in catastrophic consequences. Take the savings and loan crisis, for instance. This disaster obliterated nearly a third of all the savings and loan associations in the United States between 1986 and 1995. This crisis was birthed from a clash of regulations between the Commodity Futures Trading Commission and the Securities and Exchange Commission. It was a time when obeying one regulator could land you in hot water with the other. The 1980s saw the birth of the S&P 500 report when futures started to trade. However, due to the regulatory tug-of-war between the two agencies, the report had to be shut down and everyone's money refunded. The conflict was so intense that it necessitated a Supreme Court decision to rule that forecasting was free speech. Yet, in funds management, domestic hedging for a client was a tricky affair. If you managed a stock portfolio and foresaw a crash, you were only allowed to hedge a meager 17%. Anything above that would label you a futures fund, not a stock fund. The workaround was to move offshore and create hedge funds, which were prohibited domestically. The savings and loan crisis was also a product of Congress's unending desire to regulate things they didn't fully comprehend. There was a conflict and mismatch of regulations regarding savings and loans versus banks. With the Federal Home Loan Bank Act of 1932, Congress imposed restrictions on S&Ls, including caps on interest rates on deposits and loans. They also directed S&Ls to lend into the real estate market, while banks should primarily focus on businesses. Banks, however, were still able to offer mortgages. Between 1981 and 1985, market conditions shifted into deflation, as Volcker at the Fed raised rates to 14% to curb inflation. This move attracted capital inflows to buy bonds, which in turn caused the dollar to surge dramatically on international markets. The British pound plummeted from $2.40 to just $1.03 by 1985. The regulations on how much interest an S&L could pay meant they couldn't compete with the rates that the Fed set. In 1982, President Ronald Reagan signed the GARN, St. Germain Depository Institutions Act, to correct the conflict between high interest rates and caps on the ES&Ls. The reform eliminated loan-to-value ratios and interest rate caps for S&Ls, and it also allowed them to hold 30% of their assets in consumer loans and 40% in commercial loans for the first time. S&Ls began paying higher rates to attract funds and started investing in commercial real estate, which had tax advantages concerning amortization. So, what lessons can we glean from this? Firstly, regulatory conflicts and misunderstandings can lead to significant financial crises. Secondly, the power of forecasting and the ability to adapt to changing market conditions are crucial. Lastly, the potential for a real estate crash is always lurking when Congress decides to intervene in the market. As we navigate the current economic landscape, let's hope these lessons from the past guide our future actions.